Hey everyone, I've got a new session for you here today. What we're going to be covering is the Liquidation Hunter indicator, which is a paid indicator that you can get in a couple ways, which I'll explain later on. But if you've ended up at this video because you are either evaluating this particular indicator or you already have access to it and you just would like to learn more about how to use it, then this video is for you. So without further ado, I'm going to jump right in. And start talking about what the premise behind this indicator is. And so to start with, let's talk about liquidation zones. If you're not familiar, when you trade with leverage on either perpetual trades or just leverage trading markets, your account or your trade has a set liquidation zone. Because you're not trading one-to-one, it's actually possible that you could lose money faster or more money than you actually have in the trade. So for example, if I have $10 at 10x leverage, then instead of just trading $10, I'm actually trading $100. But if that trade goes against me and it goes, down so that the value of the trade goes below 90, now I've lost $10 already, and I only had $10 to begin with in my account. So therefore, the exchange will liquidate me and just take all that money away, even though it's only gone 10% against me in that trade, for example. Okay, so in the markets, we have these groups of participants called market makers. And they have certain jobs that they're responsible for, providing liquidity across an entire range of prices for the exchange. But of course, for themselves, they're in the business to make money. And so with that, they need to find liquidity within the chart. And one of the easiest ways for them to do that is to move the price, which they can do because they command such a large amount of capital, move that market to places that will trigger other participants' liquidation points. Okay. Now, one thing I should mention is this is a TradingView indicator, and TradingView does not give you direct access to where anyone's liquidation points are. In fact, that's not data that you would have anywhere available unless you were an insider within an exchange. Then, of course, you would see where other people's liquidation points are. Most of the time, though, even market makers aren't able to see where those liquidation points are. However, you can estimate where they are based on various price movements in the market, and that's what this indicator capitalizes on. Okay, so let's just, for example, really quick, say that I was waiting right in this zone right here, and when we got this little price pump, I got excited, I got FOMO, and I entered like in this wick right towards the top of this. Okay, so let's go ahead and create a long position, and let's say that I went long like right there. Okay, this tool's not going to exactly show me, but let's say that whatever leverage I was using, let's say I was using 25%, my liquidation zone, say, is about right there. So what then happens next is the market ends up moving against me to the point where my liquidation zone gets hit, and I'm forced to close my position with a sell, okay, which will further push prices down, and the market maker is then able to accumulate that plus all the fees that the exchange charges. And one of the things you'll find, it's an awful idea to let yourself get liquidated like this, because you will actually get liquidated. If you would just put your stop loss just before you got liquidated, you would actually still probably have about 30% of your trade or 30% of your account, if you're on cross, still remaining just by doing that one simple step, because then you don't get charged the liquidation fees and so on. And those fees are in place because it's an enticement for someone to come around and take your trade, the other side of that trade, even though the market may be going in the opposite direction at that time. Okay, that and then there's also insurance funds, fees that you pay to cover those times when the market's moving so fast that even liquidating your position leads to a loss to the exchange. Okay, but trust me, they never lose any money. Okay, so I mentioned that no one knows where the liquidation points are, except of course you know where your own are with your account. But um, because people are able to trade across any of the price ranges here, you would actually find that, and at any leverage possible, and they have account sizes of all sorts of different levels, liquidation zones actually exist across the entire range of the chart. It's not going to be that advantageous for us to map that out because it's basically everywhere. So instead, what we can do is we're going to search for the places that have higher than normal, sections of that are likely places where people have liquidation zones. Okay, so I'm going to go ahead and add this indicator to my chart now. Okay, Lick Hunter, and out of the box, it is set to use 25x leverage zones, which is a typical leverage that people use. Obviously, it's not what everyone uses. Some people use much less, some more, but we need to pick an average or something to allow us to filter out everything that we're seeing. And you'll see in this indicator, you're actually able to pick 2 different leverage areas. I tend to like only using one at a time just because it keeps my chart a little cleaner and easier to interpret. But you may find that you want to see both, like say 25x and 50x liquidation points on your chart. And I'll show you how to set that up here in a minute. Okay, so here we see these bars, and they're at different transparencies. The deeper the color shows, that means there's more layers laying on top of that area than others, and so that is a stronger zone because that means there are more people there that have the potential for being liquidated. Also, the size of the boxes, the bigger the boxes, that means that the candle that built them or caused them was a bigger candle, thus probably had more volume, and again, more likely to hold liquidations. Okay, now the way that this candle works, I mentioned that these are estimates for where liquidation zones are, but so that we don't want to just show everything everywhere, what we do is we focus on candles that some people call vector candles. Others use the term PVSRA candles, which stands for price volume support resistance analysis. They're the same thing. And basically the way that that's calculated is if you take the 10 previous candles to the one you're analyzing, and you find the average volume for those 10 candles. And then if the volume of your current candle is more than 3 times, so 300% more than that average, then you are dealing with a vector candle. And it can be a positive or negative. So it just depends on whether the candle would have been red or green, so up or down to begin with. But it's a high volume candle. We also sometimes consider the vector candles that are like half of that, so 150% of volume or higher. And this indicator does take those into account as well. So the thing to know is that the only time it would make sense for a single candle to have that much volume put against it is if the market maker is moving price, or some other giant market participant. However, that's rare because even if you have a whale in the market that wants to buy a lot or wants to sell a large position, they won't do it just with a single market buy, because they won't get the best price if they do that. Because as their trade starts to execute, the price will move through the order book and they'll end up with not the optimal price. So they'll actually just start nibbling at it in an accumulation, or if they're selling in a distribution zone, so that they take little bits at a time and let the price recover so that they get the best average price entry or exit, as the case may be. Market makers, on the other hand, their purpose is to move price. And they can do this in one of 2 ways. They can either just aggressively buy, where they just market order and the price will aggressively move in that direction. Remember that because they're market makers, they have limit orders set throughout the entire range, usually at set ranges, both above and below the price, because that's their job. Their job is to provide liquidity to the market, so that the others can trade and always know that they won't have high slippage and able to get in and out of trades. However, when a market maker wants to move price, like let's say they want to move price up, what they'll do is right before they do that aggressive market buy, they'll remove all of their limit orders above there. So there's like an immediate thinning of the order book as it goes up, so that the price can much more easily move in that direction. And it's not, it's like it happens instantaneously, so it's not something you can like always see or take action on that. Just know that it happens, and that's why market makers are able to move the price a lot faster with smaller amounts of capital. But remember that they have huge amounts of capital, so that's why they're able to do this. So anyway, anytime you see a vector candle, it's likely indicative of market maker activity. Okay, so I'm gonna actually, just to make this indicator look a little clearer so you can actually see how it works, I'm going to add in an indicator that like will show you where these vector candles are, and there's a lot of them. If you just search for PVSRA, you'll find ones that color candles. I have a custom one that I made here that I'm going to use just because it's a little more lightweight. Okay, and as you see, my candles are colored now. The red and green ones are the high volume, both up or down, and the blue and violet ones are the kind of medium, 150% of volume ones going up and down. And what you can see from this is that every place where there is a vector candle, like say this one for example, if you, in this, since this is a down, if we look up right here at this edge, there is a new box that forms for the Liquidation Hunter. And so what this is basically showing is the people that got trapped going short in this candle, their short liquidation zone is right up here. Okay, and again, like if we move on to this one, this short here, the traders that got trapped, probably they got trapped here in this wick, but you know, somewhere around here that started. If we look up here, and I know this is a little hard to see, but there is, actually it's this one right here, this box that starts right here is its liquidation zone, and so on. And for the green candles, you see the opposite in this direction. So let's pick, let's just take this one. This one looks like it's right down here. And remember, I have this set to 25x. So as far as how it's doing the calculation, it's taking this price range, because we know it has high volume, and then it's calculating where the 25x liquidation zone would be for people that entered in this candle. And of course, it's a big candle, so there's going to be a range, and hence that's why it's a box down here, not just a single line. Okay, so that's the basis of how or why these zones get created. And again, they're estimates. When you're dealing with something like this, where I'm on a 15-minute time frame, or let's say even up to an hour or 4 hour, these are very useful, especially at the, let's say 15x to 50x or even 100x areas. They'll give you zones that you can actually take action upon, and we'll talk about how to use this indicator here in just a little bit. But once you go beyond that, like, so if you're looking at a day chart, I'll just switch to one right here real quick. Okay, so here I'm looking at a daily. And you see there are vector candles here that get formed, and they do have liquidation zones associated with them, in this case 25x zones, but there's not that many. And the thing that you have to understand is that when you are looking at these larger spans, like let's say right here, this, well, that's not even a good one. Let's talk about right here. Okay, so we had candles here that created these liquidation zones that you see here. Yes, this was how many months ago? This was, you know, approximately 8 months ago. And so you have to ask yourself, is it likely that someone opened a leveraged trade 8 months ago, you know, at 25x leverage, and they still have it open today, which means that price may go down here to grab, to liquidate them? Okay, it's possible, but it's not likely, and it's not likely that there's a lot of those people still left with open trades, especially because of the way most markets work. So if it's a perpetual, or even if it's a futures trade here, the perpetuals, they would have been paying like fees to hold that open this whole time, which would not make it probably profitable. And for a future, the thing with futures is their price actually doesn't track exactly along with the spot price. It fluctuates, and yes, at the end of the contract they'll be equal, but in the meantime they won't be. So not a good use case for this type of liquidation zone mapping. Okay, but going back here to a 1 hour, this absolutely is. And one of the things, as I'm kind of going through this, you might notice is that the zones actually change as I move the chart around. And this is both a performance optimization, so that TradingView doesn't get bogged down and only shows you what's visible on the screen, but it also allows you to like only have the information that you need on the screen and not be overwhelmed with a ton of things. So like if I scroll back here further, you'll see that, give it a second, and the zones update. Okay, as it draws more in. And it's basically using all of the data that is shown on screen. Okay, and if I go back to here, a lot of that gets cut out. Okay, however, there are some times where you want to see the data based on a larger duration, but you want to be zoomed in here at the end. So the way that you do that is there is a setting, which we'll talk about all these settings here in just a sec, but right here, this limit to visible range, it's checked by default, but if you uncheck that, then what it will do is it will anchor itself to this particular look back. Now, notice how far back this look back is. So if I uncheck this, then immediately this is going to take a long time to calculate, because like I don't even think I have hourly candles that go back as far as that look back was. So it's going to go back as far as it can. So it's going to use every hourly candle that TradingView is feeding me, which is a lot because I have a premium here. But notice now as I scroll around, everything's already there, and it doesn't have to update. Okay, useful too, like if you're trying to find zones like that were outside of whatever area of the screen you were viewing. Okay, so that's that. I like to keep it set to visible range only, just like I said, because it highlights only the things that maybe are more relative to you, as well as making your chart a little snappier. Okay, moving on. Let's go ahead and talk about, well, let's talk about the premise of these liquidation zones. As I already mentioned, they're liquidation zones, so therefore they're also liquidity zones. And market makers, in order to make money themselves and also to manage the market dynamics, need liquidity in order to keep the price moving up and down. And so anytime you have a liquidity zone, price action will tend to move towards it. There's two ways I tend to use this. One, if you're doing higher end macro analysis, and by macro I don't mean like using the day or week chart. I'm talking about like, okay, here I have approximately 1 month of data, or maybe a little less than a month of data here. And I want to see where the price is likely to move. I can do this and say, is there more liquidity above us or below us? And of course, right at the current moment, we're closer to the liquidity right below us. But otherwise, it's probably pretty equal above and below. If any of you have heard of or have used High Block Capital, they have very similar tools to this. But again, they're also exactly the same. They're just estimates. But I know a lot of people use that tool to kind of help determine or forecast, I should say, the bias of the market based on where the most liquidity lies. And liquidation zones is just one way, one thing that contributes to those liquidity zones. Okay, I'm going to switch back here to 15 minutes though, and just say that in addition to to using it to set market bias. I tend to also use them to set my take profits. So I don't normally use them to like determine entries, because just because something goes down and takes liquidity here doesn't mean it's going to not continue further in that same direction. So they're not like reversal points per se. However, because they act as a magnet and they pull price towards it, if you already are in a trade and you're heading in that direction, those are good places for you to set your take profits. Okay? Or I guess stop losses, if you want to set the stop loss beyond it and hope that it doesn't go too far beyond it. I don't do that myself, but that's another way I know people use this indicator. So it's not an indicator that I keep on my charts at all times. I do have it on my chart at all times, but it's usually hidden, turned off. I just use it then when I get into a trade using other indicators and I want to see, okay, where should I set my stop losses? I turn it on, check it out, and say, okay, yeah, I think we're going to come down here, take this liquidity, so I'm going to set my first target profit to right there. Okay, something like that. Okay, so let's talk about the settings really quick. Okay, display style, by default is the boxes. If you like, you can actually change it to lines, which will make it a little, it's just a different view. The boxes assume that the closest place to price is where it gets triggered. So it just puts a line basically at the top of the box for these below price and at the bottom of the box for these above price. Some people think it makes it clearer to see like where the density of the number of candles that produced different liquidation zones are. I prefer the boxes, and I just kind of use the transparency to determine the same thing, kind of like a heat map. Okay, this transparency adjustment, depending on the colors that you choose, you may want to make it more transparent or less transparent. So essentially, if you want, especially if your screen is not showing up very dark and you need it to be darker, just set the transparency to a negative number. So like if I set this to -20, they're much, much brighter. Okay, and you can go the opposite way too. Although going upwards, I think once you reach about 10 or 15, they'll be pretty much invisible. But going in the other direction, like you could probably go down to like -50 before they're like fully bright, not transparent at all, maybe even more. Okay, so it's just a way of adjusting the transparency there. Time frame is a good one. So like if you want to be using a 15-minute chart, but instead actually looking at the zones that are calculated on, let's say, the hour, you can do that. You can also go in the other direction and use a time frame that's actually smaller than the one you're on, which allows you to kind of move around a little easier. I like just using the chart so that it changes as I change my chart time frame. I already talked about this limit to visible range. And again, to reiterate, this max look back, if, for instance, you wanted it to only calculate the zones since, say, the last macro low, which, let's figure out where that happened. Here, I'm going to switch this to daily, just help me find it quicker. Okay, and of course, yeah, that's actually about right where it was. I ran out of candles though on this exchange, so but we'll go ahead and set it right there. Okay, you can set a time if you want. The next setting down here is just related to the formula that it uses to calculate the liquidation zones. So if you're using a nonlinear contract, that is a contract that your collateral is held in the coin. So like if I'm doing a Bitcoin, Bitcoin perpetual where I hold the collateral in Bitcoin, that would be a coin M, nonlinear contract. If you're using like BTC against USDT, that perpetual contract, in theory, you'd want to uncheck this. And here, let me see if I can show you how the formula changes the calculation. Let's Let's just zoom in here. All right. So bring back this, and if I check this on and off, you'll see like everything on the screen kind of bumps up in this case if I check it, and if I uncheck it, they bump down. So, and this chart actually is against the USDT, so it'd be appropriate for me to have this unchecked. And the reason for that is that if you're holding your collateral in the coin, then that means as price is going down, the value of your collateral is actually also going down. And so therefore your liquidation zone, you reach a lot faster if it's going down. Now you have the opposite that happens on the way up, because then as price goes up, your collateral is going up. And so you would have more. But usually it all kind of, it's not that big a difference as you see as I check and uncheck this. Okay. Also, most exchanges charge a maintenance margin. If you don't know what it is, I would just leave this at 0.05 because that's what the majority do. You know, the main difference is they all have different definition of what maintenance margin is. But if you know the value for this, then you go ahead and put it in here. Otherwise, I would leave it alone. Okay, now down here for the leverage, this is where you can set this up. So like I said, by default, we're showing 25x above and below. But let's say for level number 2, I want to see the 50x. And as you see there, now it's filled in green and red where the 50x liquidations are. And like, I think if you were to tweak the transparencies on these, and with the colors, you can also set the opacities here specifically. You could probably get it where this would actually look really good and meet your needs. For me, I just prefer to just show one at a time, so you can set either one of them to 0. Actually, so let's say I set this one to 0. Then that would only leave the 50x's behind. And actually, a lot of times I even like just setting both of these to the same neutral color. Because to me, it doesn't really matter whether, you know, I can tell if it's above or below the price. So you can play with all of those. Now this setting, days of liquidation hits to show, this won't like really help you trading, but it will help you understand how this indicator works. So like, let's say I just put in 7 here. What this will do is draw all these lines that show you for the last 7 days. So now it goes back to here, which was about 7 days ago. I'm just going to zoom in here a little bit. Okay. It will show you for each one of these candles that actually broke through. And I think the way it's set up is it's got to make its way at least 80% of the way through one of these liquidation zone boxes. It'll draw a line back to the candle that formed that particular zone. Okay, so as an example, well, let's just, there's so many here. Let me go back here. Okay, so here's an example. This one right here that's pointing to this green candle right here. This green candle, as we already mentioned, is tied to this liquidation zone box right down here. And if we follow that over, this candle right here broke through that liquidation zone. And so at its tip, there's a line. There's actually a little explosion box that you can see. It goes from here and it draws itself back to there. So you can see, like when you find a candle that's got a ton of these lines drawn to it, like this one right here, you know that this candle was basically a liquidity grab that liquidated, you know, all these people. Okay, which I'm going to talk about that particular scenario in just a second, but I just wanted to finish up with the settings. That's what this setting does. Like I said, nice novelty, helps you understand what's happening, but it probably won't help you trade very much. Okay, and it looks like that's all. Not really a whole lot of settings, style settings that you can change here. And so that is that. I'm going to keep us on 50x right now, just to talk about some scenarios for this. And one of them like is right here in front of us. So there's this thing called a weekend trap. And during the weekend trap, we have usually a move that gets people to open trades, like on a Friday, and then like nothing happens all weekend long. For the most part, you might have people opening some trades, closing other trades. Hold on 1 second. Okay, sorry about that. My lights turned off. I guess I'm just trying to save electricity here. But anyway, what I was saying is in that trap, you barely have any movement all week long. And the reason it's called the weekend trap is to not necessarily trap people into trades in the wrong direction. They usually like trapping people in trades in both directions and just don't move the price enough for them to either hit a target profit or a stop loss. So they end up being trapped into an open trade. Okay, now at the end of the weekend, usually what happens is you have the market makers, they kind of come together and they figure out, okay, here's what happened over the weekend. Here's where trades were opened and not opened. So which one has more liquidity for us to go grab? And then they go grab it. Okay, and it's exactly what you can see here. And actually, I'm going to add one more indicator to my chart here just so that you can see where the weekend is. All right. So the weekend, I mean, this is Friday, right here. And then this was the weekend. So you see in that weekend, not a whole lot of trading going on, stayed within that range. But here, if we look at the 50X, you notice that throughout this time and like starting, in Friday right here, where we did have this kind of move up, I would say on average, we had a lot of people entering, and then this liquidity zone was created here. And you notice as the weekend went on, there are vector candles throughout there. It's just that we didn't price action wise move very far at all. And so we get to the end of the weekend here. Okay, here's where Asia's session started right here. And you see what happened because, and there's other tools we can look at for like to really figure out what was happening through here, like looking at open interest and CVD and whatnot. But what they ended up doing was they spiked it up, tried to grab some liquidity from up here. Probably some people stopped out and then took it down. And where did they take it down to? They took it down far enough that they could liquidate all of these people that still had trades held open from the weekend at 50X. Okay, this is, remember I have it set to 50X zones. Okay, so grabbed all that. And then once we got down there, then we started moving back away from it. Okay, and as you see now, the biggest liquidity areas are like above us. Let's get rid of that. Okay, so that's one way you can use this. I'm going to switch this back now to, let's just go back to 25X. And again, if you're trying to determine market bias, like I said, this is a tough one because they're pretty even. I wonder, let me see if I can go back to an area that it's not quite as even. Like, the problem is we just haven't had any big moves in a long time. Okay, well, I mean, as you kind of just scroll through here, you can kind of see some of the dynamics, at work here where, you had this big drop right here, grab some liquidity here, and then we pushed up, and like these first spikes basically took all of those liquidity zones that were formed by this candle down here. These all started from a little bit earlier. Let's see if we can find some more examples. Here's some big drops. All right. So again, I'm guessing like this was another weekend right here. So we did the whole trap thing, pulled this liquidity right there. But you know, as we were here, all of the people, as we were coming down, there were people going short and people going long. Their liquidity zones are above and below. It got to the point where we were here and they had to make a decision. Do we go for this up here or the ones down here? And they went for the ones down below, and you notice they pulled all of this liquidity right in this zone. They didn't get down to this liquidity, which was actually open before the big push up. And probably the reason there, if we also looked at things like open interest, one of the things that we would find is the people that went long, like say right here, which is what started opening these estimated liquidation zones down here. Well, when we hit this thing and we shot way up, all of those people like took profit. Probably not all of them. I mean, of course, that's the way markets work, but many of them probably took profits on this move up, or even if they didn't, then as it started coming back down, they probably took profits, which is why we were coming back down, that even though this zone is showing, most of those people are probably out of that trade by that point. Okay, hope that makes sense. Okay, now I already talked about how the accuracy of this tool indicator will decrease as you increase the duration or the size of the time frame that you're looking at, and also as you decrease the leverage amount that you're looking at. So like if you're using a daily time frame, there might be some use for that, but probably you're going to be looking at time frames that are so long that it becomes more and more unlikely that people will still have those same trades held open. And also if you're using like 10x, and that's the other thing, when people open like a trade on the daily and they're planning on holding it for a really long time, they're not going to use like 25x leverage. They're going to use 5x or 10x maybe at most. So at those lower leverages, the liquidation zones are going to be much farther away, and so they're more difficult for the market maker to move price to, unless it's like a larger macro type move. Okay. So I think that covers everything as far as how to use this. The best thing I can suggest is to just use the settings like out of the box and start looking at the zones that pop up at different points in the trading day, and then compare those to how and where the price ends up moving. And I think you'll be surprised at the accuracy sometimes of how price action just goes right to the edge of a zone and then will reverse from there. So once you're comfortable with how that's likely to work and the probabilities for that, then that's when you probably start using it for things like target profit zones, or just helping you decide on market bias. Again, especially on certain scenarios like coming out of a weekend trap, very useful to just like look at, okay, are we closer to the liquidation zones above us or below us? And so which one's more likely for us to go grab first? Okay, and how many of those are in those areas? All right, so the last thing I want to just talk about really quick is how to get this indicator if you don't already have it. One way is to go to the Kick Studios store, which I'll leave a link below, but it's just kickstudios.com. And if you put /shop in there, that'll take you to the shop, and this is one of the indicators available there. You can request a 7-day free trial from that point. So that's one way. Another way to get access to this indicator is to head over to Apex Trades, which is a Discord server that we're heavily involved with. And if you get one of their tier 1 VIP subscriptions, then you'll have access to this indicator and a couple others for free for the duration of your subscription. And there are others too at different VIP levels as well. So I hope to see you in one place or the other. If you have any questions about this indicator, the best place to probably find me is in the Apex Trades Discord, but you can also send us a note on the Kick Studios website as well. Okay, so I hope that you got something out of this, and that this helps you evaluate and use this indicator. And I look forward to seeing you in the next one. Thanks.